Valuation is the process that links risk and return to determine the worth of an asset. There are three key inputs to the valuation process: estimating the cash flows, the timing of the cash flows, and a measure of risk which determines the required returns. For bonds, this will be yields. So whether we're talking real estate, stocks, bond, any asset, the valuation process is very similar. We need to figure out those three things: the cash flows, the timing, and our risk measure. So the value of any asset is the present value of all future cash flows it is expected to provide over the relevant time period. So again, whether we're talking real estate, stocks, or bond, the value of any asset at time zero can be expressed as, and you'll recognize this first part and second part from our time value of money formula. So what this is saying is the value of an asset is the present value of all these cash flows discounted at a risk-appropriate rate. Discounted at a risk-appropriate rate. So this R, for the case of a stock, would be a required rate of return. For a piece of real estate, for a real estate asset, this would be the expected return on that asset. For real estate, this would be the required return on the asset. For a stock, this R would be the required return on the stock. And for a bond, this is going to be the required yield to maturity that bond investors expect when looking at. And for bonds, that R is the yield that bondholders demand for carrying that level of risk of that particular bond. For bonds, when we talk about yields, the three most commonly used are the current yield, the yield to maturity, and the yield to call. And the yield to maturity is typically the most commonly used. The yield to maturity is a measure of rate of return that investors earn if they buy a bond at a specific price and hold it to maturity. So we're assuming that the issuer is going to make all the scheduled interest and principal payments as promised. The yield to maturity on a bond with the current price equal to its par value will always equal the coupon interest rate. However, when the bond value differs from par, the yield on maturity when the bond value differs from par, the yield to maturity will differ from the coupon interest rate. So, what this is saying, with a bond that has a par value of $1,000, if you purchase that bond for $1,000, hold it to maturity, the yield to maturity, the rate of return that you earn on that bond, will be equal to the promised interest rate that the bond promised to pay. In other words, that promised interest rate that the bond pays, that is the coupon interest rate. However, anytime that the bond's price today differs from par, so anytime it's not $1,000, the yield to maturity will differ from the coupon interest rate. So bonds are long-term debt instruments used by businesses and governments to raise large sums of money, typically from a very diverse group of lenders. Most corporate bonds will pay interest semi-annually at a stated coupon interest rate. They have initial maturity of between 10 and 30 years. This is important because for corporations, large firms, bonds are typically used to finance investments, and most investments are long-lived. So the 10 to 30 years corresponds with the life of the absence. And almost all bonds, as I mentioned before, have a par value of $1,000 that must be repaid at maturity. So we can take our basic valuation model and apply it to bonds. So when we look at bonds, the value of a bond is given by the following equation. We've got this long equation that's basically saying that the value of a bond is the present value, that's what we have right here, the present value of all the interest that's paid, plus the present value of the maturity value, that par value. So when we're looking at the bond valuation, you may note that this looks an awful lot like an annuity, and that's exactly right. A bond, a coupon-paying bond, because the coupon interest payments do not change, is just an annuity. So let's go through a basic bond valuation problem. And this example is in your textbook. The Mills Company, on January the 1st, 2016, issued a 10% coupon interest rate 10-year bond with a $1,000 par value that pays interest annually. So investors who buy this bond receive the right to two cash flows. The interest payments will be $100 per year. That's the 10% coupon interest rate multiplied by $1,000, the par value. Now, if interest rates go up or down, it doesn't matter. The cash flow will still be $100 in annual interest. That'll occur at the end of each year. And then the second cash flow is the $1,000 par value that's going to be repaid at the end of the 10th year. So assuming that interest on the Mills Company bond issue is paid annually and that the required return is equal to the bond's coupon rate, so we would have interest payments of $100, a required rate of return of 10%, and a maturity value of $1,000 and an N of equal to 10 years. What is the value of the bond? Now you may say, whoa, I already know. Any time that the required rate of return, the yield to maturity, is exactly equal to the coupon interest rate, the bond is going to trade at par. In other words, it's going to have a value of $1,000. But let's work through the math on this anyway. So, basic bond valuation, we have an issue date of 2016, annual coupon paying bond. The par value is $1,000, the coupon interest rate is 10%, the maturity in years is 10%, and our required return, so our required yield to maturity, is $1,000. So, the coupon interest will be paid annual, so at the end of 2017, the buyer of the bond will receive $100, and same at the end of 2018, the same at the end of 2019, and all the way out to 2026, the 10th year. In the 10th year, the investor will also receive the par value of $1,000. And we want to know what is the value of that bond today. So there's a couple of ways we can do that. Recall from our basic valuation model that the value of any asset is the present value of all those future cash flows. So we can look at those total payments in each year, so $100 each year, and in the last year the total of payments is going to be $1,100. It'll be that $100 coupon interest payment plus the repayment of the $1,000 par value for a total of $1,100. We can calculate the present value of those cash flows. For example, for 2017, the present value in year 2016 of that $100 cash flow is $90.91. And if we look up here in the Excel cell, if you can't see this in the presentation, this spreadsheet is located in the Chapter 6 folder, and I urge you to open up this spreadsheet. We can see here, this is our basic time value of money problem for the present value. So the present value is equal to a future value, in this case $100, divided by 1 plus the interest rate, 1 plus the 10%, raised to the number of periods. And here I've just taken the difference between 2017 and 2016, 1 year. And we repeat that, of course, for the second year. Again, looking up at the formula, the exponent is going to be 2018 minus 2016, or 2 years. And the present value of $100 received in 3 years, 4 years, 5 years, 6 years, 7 years, 8 years, 9 years, and then the present value of the $1,100 to be received in year 2026, the 10th year, is $424.10. If we add all those together, In other words, we add all those cash flows together, we will come up with the value of the bond of $1,000. Alternatively, we can use the Excel present value function. So in Excel, we can just use the PV for present value function. It's going to ask us what cash flow are we referring to. So we start off with the interest rate. It's asking us what's the interest rate. So we tell it that it's in cell C8. It next asks us where are the cash flows located, and we're saying, well, these cash flows are located from C11 to L12. And it's asking us for the number of years, and the number of years would just simply be the 2026 minus the 2016, or the 10 years. And we get a present value of $1,000 as well. And you'll notice, though, that although both ways, using the PV function in Excel or simply adding up the present value of all those cash flows, yield us the same $1,000, but when we use the PV formula, we get a negative. And that's because whether we're talking about the financial calculator or Excel, they work on a concept called cash flows. So it's assuming that if you've received all this series of cash flows, so you're receiving 10 years of $100 interest payment, and then in year 10 you're also receiving that $1,000. Since you're receiving all of those cash flows, you had to have paid something to get those cash flows. So you had to pay $1,000 to receive that series of cash flows. So the financial calculators or the Excel spreadsheet will both give you a negative number, and that just means that for you personally, this is a cash outflow. This is what you'd have to pay to receive that. So if I ask you what's the value of the bond, it's $1,000. It's not a negative $1,000. The sign is just a cash flow convention that Excel and financial calculators use. So we saw that the value of the bond, sure enough, was $1,000, as we expected, given that the required rate of return, the required yield to maturity, was equal to the coupon interest rate on the bond. Again, we could have used the financial calculator to solve this as well.